Imagine a world where your money doesn't just sit in a savings account, but instead, it actively grows and builds wealth. Well, this is the magic of the stock market. Today, we're diving deep into how the stock market works, how you can start investing, and why it's such a powerful tool for growing wealth over time. Whether you're completely new to investing or just want to understand how the market functions, this guide is for you. By the end, you'll have a clear grasp of stock market basics, the types of stocks available, and how you can get started. And don't forget, if you find this information helpful, hit the subscribe button. We're aiming for 1,000 subscribers, and with your support, we can reach that milestone and keep bringing valuable insights your way. What is the stock market? Let's start with the basics. The stock market is a platform where individuals and institutions buy and sell shares of ownership in companies. When you buy a stock, you're purchasing a small piece of a company. This is known as equity. Stocks represent ownership, so as a shareholder, you have a claim on the company's assets and earnings. But why does this matter to you? Simply put, by investing in stocks, you have the potential to grow your wealth as companies expand and increase in value. The stock market, at its core, acts as an intermediary, helping companies raise funds by selling shares to investors, while offering opportunities for people like you to invest in companies and share in their success. You've probably heard of major stock exchanges, like the New York Stock Exchange, SE, and NASDAQ, which are the primary platforms where stocks are traded. Think of these exchanges as giant marketplaces where buyers and sellers meet to agree on the price of a stock. The price fluctuates based on demand. If more people want to buy a stock, the price goes up. If more people want to sell, the price goes down. How do stocks work? Now that we understand what the stock market is, let's talk about how stocks actually work. When you buy a stock, you're investing in the potential growth of the company. But stock prices don't just rise and fall randomly. They are influenced by several factors. Company performance. The success or failure of the company plays a huge role in stock price movements. If a company performs well and meets or exceeds expectations, its stock price will likely rise. For example, if a tech company releases a groundbreaking product or reports record profits, investors may rush to buy more shares, driving up the price. Economic conditions. Broader economic factors like interest rates, inflation, and unemployment rates can also influence the stock market. For example, low interest rates tend to make stocks more attractive compared to bonds, driving more people to invest in shares. Investor sentiment. Often, stock prices are driven by market sentiment or the mood of investors. If investors are optimistic about the future of the economy or a particular company, stock prices will rise. Conversely, if there's fear or uncertainty, stocks can fall in value. Global events. Events like a natural disaster, political instability, or even global pandemics can create uncertainty in the market, which leads to fluctuations in stock prices. Different types of stocks. When it comes to investing in the stock market, there are several types of stocks you'll encounter. Each offers different opportunities and risks depending on your financial goals. Blue chip stocks. These stocks belong to well-established companies that have a history of stability, strong performance, and regular dividend payouts. Think companies like Apple, Coca-Cola, or Johnson & Johnson. Blue chip stocks tend to be less volatile, making them a great choice for conservative investors looking for steady, long-term growth. Growth stocks. These are shares in companies that are expected to grow at an above-average rate compared to other companies. These companies might not be paying dividends yet because they reinvest their profits to fuel further growth. Stocks like Tesla or Amazon are examples of growth stocks. While these stocks can be volatile, they also offer the potential for significant returns if the company succeeds. Value stocks. These are shares in companies that are considered undervalued by the market. The stock price is low relative to the company's intrinsic value based on its fundamentals, such as earnings, revenue, and market share. Investors buy value stocks with the expectation that the market will eventually recognize their true worth and the price will rise over time. Dividend stocks. These are stocks from companies that regularly distribute a portion of their earnings to shareholders in the form of dividends. Companies like Procter & Gamble or PepsiCo are known for their reliable dividend payouts. If you're looking for passive income in addition to potential stock price appreciation, dividend stocks can be a great option. The risk and reward of investing in the stock market. As you dive into the stock market, it's important to understand the balance between risk and reward. The potential to earn significant returns is what draws many people to the stock market. But with the potential for high returns comes the risk of losing money. The stock market is inherently volatile. The value of your investment can go up or down in the short term, and there's no guarantee of profit. However, over the long term, the stock market has historically provided higher returns than other types of investments, such as bonds or savings accounts. Historically, U.S. stocks have returned an average of about 7% per year after inflation over the long run. But remember, these returns can vary from year to year, and there will be periods of downturns. To minimize risk, it's crucial to diversify your investments. This means spreading your money across different sectors, industries, and even types of assets, like stocks, bonds, and real estate. Diversification helps reduce the impact of poor performance in one area by balancing it with gains from other areas. How to get started investing. If you're ready to start investing, here's how to get started. Set your goals. The first step in your investing journey is to define your goals. Are you investing for retirement? Do you want to grow your wealth for the long term, or are you looking for short-term gains? Knowing your goals will help you make better investment choices. Open a brokerage account. To buy stocks, you'll need to open a brokerage account. This is your gateway to the stock market. You can choose from traditional brokerage firms like Fidelity or Charles Schwab, or online discount brokers like Robinhood or E-Trade, depending on your needs and preferences. Start small and stay consistent. Don't feel the need to invest large amounts of money right away. Start small and gradually increase your investments as you learn more. Many brokers now allow you to invest in fractional shares, meaning you can buy small portions of expensive stocks, making it easier to start with a limited budget. Consider exchange-traded funds, ETFs. For beginners, investing in ETFs or index funds can be a great way to get started. These funds pool together money from many investors to buy a broad selection of stocks, giving you automatic diversification and reducing risk. Long-term strategy and patience. The most successful investors are those who play the long game. The stock market is a marathon, not a sprint. While there will be moments when the market seems volatile or you experience losses, the key is to stay patient and keep a long-term perspective. Over time, the market tends to recover and grow. By staying invested, continually learning, and adjusting your strategy based on your goals, you'll be well on your way to achieving financial success through the stock market. Conclusion. In conclusion, the stock market is an excellent tool for building wealth over time, but it's not without its risks. Understanding how stocks work, diversifying your portfolio, and maintaining patience are all essential for success. The key to being a successful investor is continuous learning and staying disciplined in your approach. Remember, the stock market rewards long-term commitment, so don't be discouraged by short-term fluctuations. Thank you for sticking with me through this overview of stock market basics. If you found this information helpful, don't forget to hit the subscribe button so you don't miss out on more valuable content. Keep learning, stay patient, and happy investing.